Thanks for having me, Greg.
So let's start right there. Inverted yield curve. 3 words that set off so much selling on Wednesday. You take a look at that chart. What is it telling you?
Well, I mean, I don't necessarily know that an inversion of the yield curve has created any selling. It's not like this is a surprise, Greg, right? It's not like we woke up one day and it's like, oh man, the yield curve inverted. Where did that come from, right? Most of the yield curves around the world have already inverted. If you look at the shorter end of the US yield curve, it had already been inverted. So we've really seen this coming ever since really 2015 when we broke 1.2 on that yield curve to the downside. On the 2s, 10s specifically, right? That's what we're referring to. It's the benchmark, if you will. But again, it wasn't a surprise, right? We've seen this coming. And traditionally, stocks do very well in an environment that the yield curve is falling and inverting. So I don't want to say that this is a buy signal, but traditionally, an inversion of the yield curve is consistent with stocks doing very well. So I don't necessarily think that the inversion has caused any sort of selling.
Now, some people who don't follow these things as closely as we do were surprised when they asked me about the yield curve inversion. If they asked me, you know, Wednesday night or, you know, yesterday or today, I'd say, well, it's not inverted anymore. It was only about 4 hours on Wednesday. So again, this feeling that we make too much of all this.
Definitely making way too much of it. But that's, you know, that's the job of the media, right? To make a big deal out of little things from, you know, from my perspective anyway. So number one, even if, let's just say it is a heads up that we're going into a recession, depending on who you ask and depending on where you start your data set, recessions happen 12, 18 months after the inversion of the yield curve. So even if the media is right and this is the beginning, this isn't something that we're going to have to worry about until late next year anyway. So as far as the market itself is concerned, if we're going to make decisions on the stock market based on what may or may not have happened in a yield curve in a recession that may or may not start 12 to 18 months from now, I think it's foolish. I think we need to focus on the stock market that's in front of us.
Okay, one place that often gets overlooked, but some people use it as a bit of a bellwether, would be the small cap stocks in the United States. What are we seeing there?
Well, I don't, if people were suggesting that the small caps outperforming is a bellwether, you know, I would push back on that very, very hard. There's zero evidence historically that small caps need to outperform large caps. To the contrary, I mean, look, just, you know, after the World War II period, large caps really dominated. Look at the late 90s. The entire second half of the late 90s was dominated by large caps. And as if I recall correctly, stocks did pretty darn well in the second half of the 90s. So it's not so much that small caps need to outperform, but if we are going to continue this structural bull market or begin a new cyclical bull market for that matter, I think we do need small caps to participate. So that's some of the rotation that we are looking for. You're seeing underperformance out of the transports, small caps, mid caps, micro caps, right? Internationally, right? We're not getting confirmations. We're not getting new all-time highs like we are in U.S. large caps. But let's remember that U.S. large caps are being led by technology, and that's really the common denominator. If you look at all of the underperforming assets, or many of them for that matter, small caps in particular, since we're on the subject, small cap technology looks way better than small caps as a group. Look at technology within financials. Look at the mobile payment companies, right? That's tech within financials, and they're doing fantastic, right? Look at the technology in different sectors, like even in healthcare for that matter. The medical equipment stocks are doing much better than healthcare as a group, because medical equipment stocks are essentially tech stocks stuck in a healthcare body. So, you know, when we're looking at that, I think we need to figure out what's underneath the surface. Small caps have a ton of exposure to regional bank stocks. And with interest rates getting slammed, regional banks are underperforming. And it's not just a U.S. thing, it's a global thing, right? Any countries with a lot of banking exposure are underperforming. That's really the story, because other countries and other areas around the world don't have the exposure to tech that the U.S. has.
All right, JC, when you mentioned the fact that just like with the larger caps, the technology plays can sort of lift up a benchmark index. Let's take a look at the S&P 500. This has been a criticism I've been getting from people who didn't believe that much in the rally. They kept pointing to the concentration of the tech names. When you take a look at the S&P 500 from a technical perspective, what does it tell you?
Well, these tech stocks are the biggest names in the S&P 500, right? So traditionally, when the stock market is doing well, it's being led by the biggest names. And there's nothing wrong with that. That's perfectly normal. My friend Todd always tells me, he's like, JC, the best players are supposed to score all the points, right? So, the S&P 500 is a momentum strategy at the end of the day is what it is. Because the index buys more of the companies that are doing the best, right? So I think it's okay for the biggest names to be leading the market higher. Where I think the problem is really in a much broader sense, the breadth, right? We're not getting an expansion of stocks making new 52-week highs. We're not getting an expansion of stocks showing bullish momentum readings, right? We're not seeing an expansion. We're not so much seeing a contraction either. We're just not seeing that expansion in breadth yet that I think is certainly what it's going to take for the S&P 500 to begin its new leg higher after, 19 months into this correction? That's a long time, Greg.
All right, JC, earlier today we heard from Brian Moynihan, our Bloomberg partner, sitting down with him, and he said, you know what, if you want to worry about recessions and economies, it's not a North American phenomenon. Like, look at to the rest of the world. So if you take a look at the Global 100 index, what is it telling you?
We stopped going up in January of 2018. Similar story to the S&P and the Dow. I just think this chart is just cleaner, right? We failed there in January 2018, failed again coming into the fourth quarter last year, failed again in the second quarter this year, and recently tried to exceed those former highs and failed. So to me, that's just further evidence that we are still globally and domestically in the midst of a major range. This is a cyclical bear market. There's absolutely no question about it. But I think that structurally, bigger picture, I think that's a good thing for the overall structure of the market. Remember, 2016 and 2017 were great years. So to have a correction or a digestion of those gains is not out of the ordinary at all. In fact, it's perfectly normal. So when we start seeing new highs in the Dow Industrials getting above 27,000 and holding above it, S&P's above 3,000, holding above it, the Global 100 Index finally breaking out above those highs from last year. When you start to see all of those things happening and we're getting an expansion in breadth and an expansion in participation, I think that's going to be the heads up that we are at the beginning of a new cyclical bull market. And I think that's exactly what we're going to see. We're just waiting for that confirmation.
All right, JC, always great to have you on. Thanks for sharing your insight.
Yep, thanks for having me.
That was JC Parets, the president and founder of All Star Charts.